You're about to join Jerry Parker, Moritz Seibert, and Niels Kostrup Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Hey everyone, and welcome back to another edition of the Systematic Investor series, where each week we discuss and debate what's going on in the world of rule-based investing right now. My name is Niels Kostrup Larsen, and I am excited to welcome my co-hosts Jerry Parker and Moritz Seibert. Good morning, guys. How are you?
Great.
Good morning.
Great. Well, it is Sunday today, so it's a relaxing start to or end to the weekend, I hope. So interesting week, I thought, in some ways, some interesting moves in some of the bigger asset classes, I would say. So what was your sort of experience, observations when you look at your portfolios this week? Moritz, how about you? How's the week been for you?
It's been a rates-driven week, right?
Yeah.
Above anything else. So we've actually made some money from being short T-notes, US bonds, and lost a bit on the JGBs and the Bunds and some of the other German bond markets. But overall, a slightly positive week. Other than rates, a bit of losses from the equities, but offset partially with gains from some of the energies. Pretty normal trend following week, really.
Yeah, I agree. I mean, we've certainly seen the same moves on our side. Fixed income in the US doing well, pretty flattish in Europe. Energy doing well, and some of the currencies actually doing okay. And a little bit of profits from being short some of the European equity markets. So yeah, so far so good. What did you notice this week from more the trading side of things, Jerry? Interesting markets breaking out, perhaps. I think we know which market we're thinking of here.
Yes, we're finally got our natural gas breakout
That's
to
right,
the upside.
yeah.
So that's something different we haven't seen in a while. Maybe it'll keep going. It had a blast off and small little setback. Was happy to see the dollar trade looking better and a rally there. Most of the markets that we trade, some of the currencies are finished near their lows. Individual stocks, I don't really trade the indices anywhere, anytime, any place. The individual stocks, they hung in there. They're not bad. Okay. They're all pretty close to their highs. Some of the U.S. interest rates were definitely in a definable downtrend, and some had rallied. And so the 30-year and the 10-year making new lows, and some of the European rates looking like they may turn into a downtrend as well, those bonds and notes. And so there's some hope there that we'll get that everyone knows this is the obvious trade. I'm a little skeptical just because of that, but I'm going to go with the trend. So that's good.
Sure. And we're not the only ones going with the trend. I think there was a headline out that there's like the biggest short position in U.S. fixed income futures at the moment ever on record. So clearly a lot of people, trying to at least hedge some of their exposure. And I think sometimes people forget, we talk a lot about stocks, but I mean, the bond markets are something like, 10 times or more bigger than equity markets worldwide. So it's an important asset class, but and it'll be interesting. I mean, I've been talking a little bit about lately about sort of this correlation between fixed income and equities, and how for the past 10 years since the financial crisis, it's been unusual because it's been, for the most part, something like 87% of the time, it's been negatively correlated, which is great if you're running some kind of risk parity strategy or whatever. But if you're looking for protection, then people ought to know that, if you go out 50 years or 100 years or even 200 years, it's the complete reverse. It's about 2/3 of the time where they're actually positively correlated. And I guess on a sort of personal level, I worry a little bit about that. That might not be what we're going to see in the markets for a while, where maybe both fixed income and equities can run into some trouble. Time will certainly tell. Anything else you want to add? I guess there weren't that many sort of trend changes as such. Not that I noticed, at least.
I tweeted.
Oh, but I had a question. Yeah, go ahead.
I tweeted a rude comment about the sugar rally, and maybe the vol had been going up for a while, and I thought hit some key levels on the upside, and maybe the vol targeting CTAs got in there and maybe ran up sugar and coffee this week. But then someone kind of corrected me on Twitter saying it has something to do with the Brazilian elections or something. So
All right. Okay.
Those two markets had been in long-term downtrends, and there was a pretty nice rally in those.
Yeah.
So maybe that's over.
Yeah. No, I did notice the soft generally were sort of getting a helping hand for a change. One thing I meant to ask you, Jerry, you mentioned about the single stocks. When you look at your universe of single stocks at the moment, are they predominantly, say you trade 100 different ones? I don't even know how many you trade. Are they just from a pure number? Are most of them still in long trends, or how does that split? Do you follow that sort of relatively close?
I do. I follow it closely. I go through and analyze that once or twice a week. And
okay.
First of all, we built the portfolio strictly to get as much diversification as possible. As I've mentioned many times, 2 or 3 stocks from each industry or something like that. And we run it through our software, and we have a very diverse portfolio most of the time, of course. And so it's developed in that particular way, so to increase the chances that not everything would be in an uptrend, unfortunately. So, so it's maybe 50%, 40% of the stocks, or you can even say that are kind of in an uptrend, some very much of an uptrend, some not in a downtrend. It's about the best you can say. So it's really a mixed bag. It doesn't look anything like half the stocks look nothing like the S&P.
Right.
May I ask, Jerry, are you trading U.S. stocks only or global?
Global, but just a few ADRs. But I really can't tell the difference. We're just so used to looking at all the different markets individually and separately that I also tweeted an article this week about commodities and about how no one looks at commodities and says, what are commodities doing? That's a crazy question because there's so many different ones. They all have different patterns, and I look at the stocks in the same way. I try to stay away from the constant drumbeat that the market is doing so and so.
Exactly. Yeah. There is no the
But
market.
On the short side, are you able to go short the single stocks, or do you have to go short the indices?
No, we short the single stocks.
Okay.
Yeah.
Okay, cool. Well, I mean, just on sort of on a regular update, sort of from my trend barometer point of view that I track for diversified portfolio, it finished actually a little bit, above neutral zone this week, and I sense that the industry is off to a positive start for October after a pretty neutral finish in September. But let's jump to some of the other tweets that you've been tweeting this week, because I think some of them are also relevant for sort of the news flow that we've all noticed this week. There's a lot of interesting articles going around. So why don't we jump into to your top tweets, Jerry?
Well, certainly most of the people who follow me, they're interested in trend following, as am I. So the most popular liked tweet this week had to do with the Cliff Asness interview. Fascinating interview. He's really fun to listen to, really smart, very unique. And he has blocked me on Twitter, so maybe I'm making a pitch that he unblocks me. But short of that,
Let's hope so.
Yeah, I do admire him and like him. And people seem to really be concerned, like all of us trend followers, we want it to work. And is it still working? And I get a lot of positive responses whenever I tweet something from someone or from myself that makes people think, yes, trend following still works. It's still fine. And so he was asked a question about Winton and the emphasizing trend following. And he said, basically he felt like it was just a response to competitor pressure from people who trade trend following and charge less than he does. And he says, blame it on me. I'll be happy to take the blame. And so people were very happy to hear that Winton might not be de-emphasizing trend following because they don't think it's going to work in the future. It's more of a business situation of, especially everyone feels the need to figure out a way to keep the incentive fee going. And the way the industry has been moving is that if you want to charge an incentive fee, you have to have less trend following.
Yeah, what did you make of the article? I have to admit, I haven't read it in details. I've only seen the headlines, Moritz. What did you make of it? It's obviously a big topic that Asnes touched on this week again.
It's been a great article. I read it, and like Jerry, I enjoy the way that he talks. It's he speaks in a funny way. As far as the trend following not working or working is concerned, I mean, he also said that, well, they've reduced Winton, that is, they've reduced the allocation in their larger fund, but they still have a lot of money in trend following. It's not that they're saying it's no longer working, right? Because if they said it's really no longer working, then the allocation should be zero. But that's not the case as far as Winton is concerned. And they've also spun out a standalone fund that's tracking their trend system only. So, yeah, I think it is a business decision, given the fee environment and just the number of products which are out there already that offer good trend following strategies for very competitive flat fees.
Yeah, I mean, I know we probably have different opinions on this. I'm not a big fan of flat fees, to be perfectly frank. I don't see any benefit for investors to invest in a flat fee product because there's no incentive for the manager to do well. It's just a matter of size, really.
And I agree with that. Sorry to interrupt. I agree with that also, and we spoke about that, right? But you and I and Jerry, we're not the average investor out there. I think for many investors, that's exactly what they want, right? They like it. They like it that it's a flat fee, UCITS or 40-Act type of fund. And, I think it's good that those products exist and they offer an opportunity for people to invest. We're not saying, and I'm certainly not saying that's the best, possibly, or certainly the best way to do it. Yeah,
no, I agree with that. I think it is good that there is this opportunity for people to do so. But when it comes to this thing about does trend following still work, et cetera, I mean, I do think that maybe simpler versions of trend following work less well, or it's not to say they will work less well in the future, but they seem to have worked less well in the last few years. And I think that touches on another article. It's not really an article, it's an interview that I think we all saw with perhaps the most successful investors of our time, which is Stanley Druckenmiller, the former partner of George Soros, who, when you see the interview, and this is a paid interview, so it's not something you can just download and watch, but since we all subscribe to I think Real Vision, it was where it was, and Druckenmiller talks about how he, and I know Jerry tweeted about this as well, he talks about how he develops a thesis, and as the price starts to confirm his thesis, he starts to really pile in, and that to me sounds like trend following. So I got even more curious when I heard that part of the interview and what it led to, and which may tie in with this thing about, does trend following still work, was that he commented on that for the first time in his career, he saw some changes. He saw changes in the way the markets were behaving due to algos. And I don't mean algos like trend following, which is really just simple rules. I mean other kinds of algos. And I think that's what he was referring to, whereby these algos are designed that when the market moves a certain number of standard deviation away from its mean, they come in and they do the opposite. Essentially, they try to bring the price back to its mean. And clearly, if that's the case, And if indeed these algos have significant volume behind them, it kind of explains to some extent that the price range of many markets have been compressing. At the same time, we know that the volatility has been compressed over the last few years, not just in equities, where we have seen it very clearly, with the VIX trading at exceptionally low levels last year and the beginning of this year. But in many other markets, if you look at volatility in commodities, if you look at volatility in fixed income, it's really been going down for a long time now. So I think maybe the combination of these other types of strategies or algos combined with, and which are probably also why the volatility of the markets are being compressed, because they're keeping them in some kind of range or narrow range. So those were the things that I picked up from that interview. I didn't see the full part of it, but I thought it was very, very interesting, because it's not something that I've been thinking about, because I don't track what generally other algos are doing. But he clearly does, and he feels that it's impacted his ability to deliver the same kind of returns that people know him for. What did you make of that conversation?
It's been a treat to watch him one evening this week. First of all, really enjoyed that interview. I think, if I remember correctly, what he said is the markets don't follow their normal rhythm. I think he used the word rhythm or something like that. And it's because of the algos, because of people trading factors, smart beta, subsumize all of that under algos, right? And may have a point there. He also said that when asked by Carol, he asked, do you have any money allocated with a machine? He said, yes, I do, since, 1 or 2 years, but those guys are under review. Let's see if they're up to something. So he, I found that interesting. So he's not the just discretionary global macro trader. He's also allocating certain portion of his funds to algorithmic trading.
Sure, but I also, and he did certainly confirm that, that he was using quote unquote, technical analysis, which I still, the way he phrased it, thought of as being some kind of trend following, rules. I'm not suggesting that that's what it is, but it certainly sounded like that. What about you, Jerry? What did you pick up from that conversation, and in general from these two big topics of the week?
Well, I'll make a habit of reading things like this and maybe building up my own kind of understanding of what this person meant, which may not be anything close to what he really meant. But
sure.
I feel like that it's a lot of the things that you guys have said, I think typically over the years, I just scoff at. Like, whoever is saying these things, of course the markets are changing. Of course it's different. Of course the rhythm is different. Your problem is you're paying attention to something other than price. Stop doing that. And so this is why trend following is so wonderful, is that no matter what's going on, our system, our entries and exits, our momentum trend-based way of doing things is going to get us in on the right side, and hopefully we'll stay in gear and stay in the trend before it, and we don't get knocked out, and then we stay in long enough and we walk away with some profit. So I'm sort of fascinated, coming from my background and my 30-some years, just the human desire and need to have trend plus something else. I need something to confirm this. The quote that I tweeted was from Druckenmiller is, I build a thesis, hopefully that no one else has built. I put some positions on. When these start to evolve and the momentum starts to change in my favor, then I pile into the trade. Well, okay, I forget the first part and I just wait to see the momentum change in my favor and I stick with it. I go with the momentum. So my brand, my slogan is trend following plus nothing. I'm just always amazed that the human brain and most smart people, they need something else. And I don't really know if that's adding a lot of value, other than maybe it just makes them feel better. And if, maybe if Druckenmiller had worked for Richard Dennis, he would feel different. And if I would have worked for Soros, I would feel different. So it's maybe circumstances, but that. And I think another thing he said, I think this is correct, is that he said something that contradicts, I think, what most trend followers said and what I said last week, is the shorts are not as good as the longs. And I believe he said he made a lot more money on the shorts.
Yeah.
So that was interesting. And then he did talk about bet size and in a roundabout way, throwing on a big position when he really felt a strong conviction. So maybe that's how you make a lot of money in shorts is we size inverse to the volatility, this approach for every single trade. And he says, oh no, on this one, I really feel like we're at a high and the market's at a really overvalued and the trend is sort of going with me. So I'll really slam it on. It's really way too much discretion for me.
Yeah. No, that's interesting. And actually speaking about, since we often refer back to AQR and their content, and they do produce a lot of great content, I did hear their latest podcast episode, which was actually the debate about systematic versus discretionary trading. And I thought that was a fascinating conversation. And I think that the key takeaways were really, to a large extent, was really how, and I think they had the founder of Maverick, one of the largest hedge funds, on the show as well. And he basically said, my analysts, they may only have 2 or 3 positions. They only follow 2 or 3 companies. They need to get to know them, better than the CEO and so on and so forth. And of course, AQR comes in and say, well, we do the complete opposite. I mean, we diversify as much as we possibly can. But what was interesting about it, they had done some kind of large study on performance, and this I think will surprise people. So their conclusion was that both type of strategies, if you look at a large universe of discretionary managers and systematic managers, to a large extent over different time frames, the performance was not that different. But what people may be surprised about to know is that the systematic guys had much less risk. And I thought that was interesting because I think a lot of people believe that when you have a human person doing it in the background, that there should be less risk on that side, and systems are, will end up being much more risky. But in fact, the conclusion was the complete opposite. So more or less same return, but the systematic guys did it with less risk. And therefore, I guess you could say that the risk-adjusted returns were higher. And so I thought that was interesting.
Yeah, the systems
very interesting.
Are objective, that are rule-based, and it's really the only way to get into your portfolio lots of diversification, lots of currencies, commodities, stocks, bonds, long and short. So without the systematic approach, it's difficult to, diversification is so powerful.
Yeah. Yeah.
Coming back to Druckenmiller, I mean, the fact that he's done 120 calendar quarters, 5 of them being down, right? So it's 114 up quarters. And so he's been going through all those markets. So certainly he's got a feel for risk. He's doing it in a discretionary way. But, when you listen to this interview again, he strikes me as this, like he's taking in a ton of information, listening intensely, focusing intensely, wants to understand and learn all those things. And, when he then says, okay, I'm building up those small positions. So, throwing arrows at the wall, seeing what sticks. And then only if it, shows the conviction and that follow through, then I'm going to pile into the trade. And then again, with respect to risk, he also said, if I remember that correctly, those really big trades, he's only doing in markets which are like super liquid, bonds, currencies, right? So that he has at least the opportunity and a chance to get out, right? And get out quick if he's proven incorrect.
Yes, and he did say as well, and maybe that's an interesting observation with regards to the point that he mentioned that he had made more money in the down years, but he also said that most of what their really big trades were in currencies. It wasn't really equities per se. But what you said, Moritz, is, I mean, but that's what we preach in trend following, right?
Yeah,
I mean, as our systems get more convinced the conviction level builds up with the signal strength, we add to that position up to a certain level, and he's just doing it in a different way, but the principle is the same.
And I agree. So, we do it in a systematic way. And I also, I think, Jerry, I just remember that this week you tweeted also an article, which I found was real funny, saying, if done properly, then asset management is a 24/7 type of job. Well, I don't know. It definitely isn't 24/7 for me. And that's one of the beauties of that systematic approach, right? Just follow the price. I mean, if our systems, I don't want to say become convinced, they take on more trades, they also would pile into trades, at least, on my side, that would happen, and increase the position size, right? And it's just all done automatically. There's no 24/7 to that at all.
Yeah,
right.
and the more and I think there's lots of evidence that the more you try, the harder you work. If it's discretionary, you're not going to be nearly as good as a rules-based approach. And that's kind of the issue there. I'd like to reward you for all your hard work and sweat and your 24/7 and never seeing your children. But actually, the truth of the matter is you do a lot better if you worked less and just followed some rules.
I was listening, so I'm in Orlando this week, and I was listening to a podcast, on the way over here, and it was about thought reversals and how you deal with these things, and it's really about busting myth. And the example they used was really this thing about, a lot of people believe that the harder you work, the more successful you'll be. But the truth is that if you just ask the question, does that mean that everybody that works hard becomes successful? And of course, clearly the answer is no. So I agree with that, Moritz. That this doesn't have to be a 24/7, work situation in order to be successful in with your investments. And going on from there. And this whole, and I heard another great interview this week with Tony Robbins, who obviously have been interviewing some of the most successful investors in the world when writing his latest books, and it's very clear that a lot of their strategies, their success was based on true diversification over asset classes and within asset classes. And when you do that, it actually takes, I think, less time to have a successful or run up a successful portfolio than if you want to, get every single tick out of just trading the S&P. That's definitely a 24/7 or 24/5, work situation unless you are fully automated. So sometimes it's not intuitive that you can become very successful also as an investor, and actually don't have to spend that much time on your portfolio as a whole. So interesting. Now, it wasn't all good, I think, in the press this week. I think there was another article you tweeted about, which I didn't read either, which something to do with the 200-day moving average. Can you pick that up, Jerry, and what was that all about?
Yeah, it was an article in Barron's, and the title of the article was "The 200-Day Moving Average no longer works. A market timing tool that no longer works." I've often wondered. I've been a little unsure what is market timing, and then because one guy will write an article on Monday that market timing doesn't work, and then on Friday he's extolling the virtues of trend following. So so it's not the same thing. So I think this article really helped me focus on what do these people mean by market timing. And I think what they mean is an indicator that tells you now's the time to get out. It's not a system. A system has an entry, a system has an exit. One of the complaints about this 200-day moving average, is 200 days, is that long term enough? Should it be 300? Should it be 100? That wasn't really delved into. Didn't seem to be a lot of interest on getting to the bottom of anything except to say this sort of indicator business doesn't look like it's worth anything. And he pointed out the last 4 or 5 times there, that was really the bottom of the market of the S&P, and the S&P rallied off of that. So And I guess implicit in that is that an indicator would have to have a 50% or 70 or 80 or 90% success rate. So anything less than, and of course we know as trend followers that we're perfectly fine with a 40% success rate. And so the whole systematic approach with an entry and exit, a stop loss, is much different from an indicator approach, which I think is somewhat worthless. They will also throw out when this indicator is tripped, what happens to the market 3 months later, 6 months later, 9 months later. And we're going, what are you talking about? Where's your exit? That was maybe a sell signal. Where did you get out? And it's just two different ways of looking at the markets, both seemingly to be similar and maybe technical in nature or moving average in nature, but it's really different. And the disappointing thing about the article was there was no attempt to educate or get to the bottom of the benefits of using moving averages. And in fact, one of the quotes in the article was, this is not enough data to say that this doesn't work any longer, or moving averages don't work any longer. So it was really confusing and not an addition to the education of the average person who reads Barron's. It was really disappointing.
Yeah. Did you read the article, Moritz? I didn't, I have to say.
Yeah, I read it very briefly, though. I mean, we've touched on that before. It comes up all the time, the S&P 500 and a 200-day moving average, and then jumping to conclusions and calling that a system, whereas, I don't think that's a system at all. That's just, one indicator applied to one market. And I find it very difficult to infer anything from that, really, because even if you do, like you have those 200-day moving averages you apply to the S&P 500 for the past 20, 30, 40 years. I mean, how many trades does that, how many signals does that really produce, right? And you end up with still a relatively small sample size that is noisy and volatile, and doesn't allow you to actually derive a system from that, because there's really nothing to build it on. And yet it comes up all the time, this one indicator, this one market only, and then people say it's working or it's not working, whereas it's completely besides the point, I think.
Yeah, I mean, it seems very naive to even suggest that, but I think I understand where it's coming from, and I think unfortunately this is what a lot of maybe the private individuals are being exposed to through people who are offering, software or systems or books or whatever. Excuse me, that is meant to solve their problem and make them better investors overnight by following some relatively simple rules. I mean, if I just look at on our side, and I'm sure it's the same on your side, I mean, we have hundreds of combinations of parameter sets that we can choose from. And so, just looking at one indicator, as you say, is not very helpful.
And you also let me say that I think I emailed with Jerry and said, I haven't checked, but I wouldn't be surprised if that same indicator, that 200-day moving average, if you applied that to, say, 150 markets, right?
Right,
with
yeah.
vol-based position sizing, you kind of like make a system out of it. I wouldn't be surprised if that looked good.
Sure.
I don't know. I haven't checked, but
no.
Right. So sure. Just looking at the S&P 500 because everyone's looking at that one market has nothing to do with trading a diversified portfolio in a systematic way.
No, and we know that even trend following systems, if you just trade one market like the S&P, it may not be successful for years. I mean, right. I don't think we made a lot of money in equities prior to 2017 for quite a while. Yeah. Let's jump to just to see if there's any questions we can quickly answer this week. I've got on my side got a couple of questions. There is one from and I hope I pronounced it correct, but Mohit, and it's about moving averages, strategies, and maybe we want to do that next week. It's a little bit more expanded question, and it is focused on many different things. And maybe I should just say, Moritz, that none of us actually trade moving average systems, but we will try and attempt to answer that for you next week. So we do appreciate the question. But I did get a shorter question from Barry. And this is actually a specific question for you, Jerry, and it's pretty straightforward. And that is, do you utilize synthetic instruments and to what ends? And are there any criteria and goals for assembling the instruments / spreads, etc.? So a question from Barry to you, Jerry, on that.
I have looked into these synthetic spreads, crosses. I'm intrigued by these. I think that it's worthwhile to look into that and maybe trade on a selective basis. I believe that my initial idea was just to say, hey, wait a second, if sterling yen and euro Swiss, or if they can be a trade, what about euro gold or gold euro or silver gold, a spread or a synthetic or whatever, and these relationships, will they trend? And of course, the goal always is the same, diversification. If I trade gold and I trade silver and I trade the gold silver spread, what sort of diversification is this adding to the portfolio? Because I'm going to use the exact same system, same entry, same exit on all the markets, on the spread, on the synthetic, whatever you want to label it. And so how is this helping my diversification?
Yeah, I mean, I've got two thoughts on that. One is, I would say to Barry, you might want to listen to the episode or the interview I did with TransTrend, Harold de Boer. They trade synthetics, but he also commented on that they might probably, or they are, or doing less of that now. So you might want to listen to that episode. It's one of the more recent ones from this spring. So they have some experience in that. And incidentally, it's quite interesting. You mentioned this synthetic if you combine other things. I mean, I was just picking up this weekend. I noticed that, for example, oil measured in renminbi is up 47% this year alone, since February, 47%. So there are trends when you start combining some of these things, that's for sure. But, another thing I picked up, which is completely unrelated to what we talked about before, but in terms of trends, I mean, people say, okay, markets are not trending, but this week, I think oil hit, tripled since the low in February 2016. So clearly markets do move, regardless of what people might say. Anything on your side, Moritz, you wanted to add on that?
No, nothing to add, really.
Okay.
No.
Okay. Yeah, as usual, I just want to quickly give our listeners a quick update on the industry as a whole. And as you may remember, we can only see the data as of Thursday evening, since we're recording this over a weekend. But we are off to a good start for the industry in October. The BTOP 50 index is up 0.72, still down 1.93 for the year. The SocGen CTA index is up just shy of 1%, down 2.5% for the year. The trend index, which is more closely to our hearts, is up 1.19 for the month and down 2% for the year. And the short-term traders index is up 0.64 for the month and up 1% for the year. And finally, the flat fee index, Bridge Alternatives, is up 1%, 1.06 to be precise, down 4.76 for the year. Anything else, guys, that we should discuss this week? Anything that you want to bring up?
Well, I had one more interesting set of tweets that sort of ties in with Druckenmiller, or at least my take on what I thought was interesting about the Druckenmiller, and which is, once again, the trend following plus other things. This desire to have the fundamentals maybe line up or have something else to go with the trend. And AQR did a study. I tweeted it at least 3 times, pretty much saying the same thing, And it is basically, they did a 91-year study that said that markets tended to go up when prices were very high, meaning that investors who attempted to time the market based upon market valuations could have missed out on a great deal of return over the long term. So a couple other tweets saying the same thing, basically. Please do not look at anything other than trend. If you allow other fundamentals, valuations and risk or whatever in the markets, old methods of measuring whether you should be long or short stocks or out of stocks, you will miss profit as it compared to just following the trends. So I thought that was very interesting and certainly something I agree with wholeheartedly. So I wanted to tweet it, and I nonetheless am amazed at how successful Soros, Druckenmiller, and all those guys are. And it's really fun to try to figure out from our worldview, which is strictly trend and momentum and numbers and prices, how they did so well, hoping that maybe part of what made them successful is what we think really works in the market.
Yeah, no, it certainly sounds like it wasn't just pure seat of the pants trading. When I listened to Druckenmiller, there seemed to be a little bit of a hidden trend follower in him as well. So maybe it's not all bad. I think that's very interesting, and I also noticed that there's another study that I'm going to be catching up on this week. Again, from the same source. Seems to like we're quoting them all the time, which is great. They do produce a lot of good content. So that's to do with the drawdowns over 100 years or something like that they posted also. And so, yeah, well, I mean, if there's nothing else, let's wrap up this week's conversation. We hope you enjoyed it just as much as we enjoy making them for you. And if you felt you got something out of it, please share these episodes and do leave a rating and review in iTunes. They really do help us. From Jerry, Moritz, and me, thanks so much for listening, and we look forward to being back with you next week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.